Introduction to Asset-Backed Securities. This is a long reading with many sections. We'll talk about how securitization works. Then we'll discuss the structure of one particular type of securitization, and this will help you understand the securitization process. We'll then talk about residential mortgage loans. And the reason we talk about these loans is that they form the basis for the mortgage-backed securities that are a major part of the fixed income market. So understanding how residential mortgage loans work is very important. They are the basis of mortgage-backed securities. Then we talk about different types of mortgage-backed securities. We'll discuss mortgage pass-through securities, which are the simplest type. Then we'll have more advanced securities such as collateralized mortgage obligations. We'll also talk about the difference between agency and non-agency residential mortgage-backed securities. In section 7, we'll discuss commercial mortgage-backed securities. These are mortgage-backed securities that are backed by commercial mortgages as opposed to residential mortgages. Then we'll discuss non-mortgage asset-backed securities. So, for example, securities that are based on auto loans or securities that are based on credit card payments. Then we'll discuss collateralized debt obligations. And finally, we'll talk about covered bonds. At the heart of asset-backed securities is the securitization process. What we'll do here is understand a very simple securitization scenario and also familiarize ourselves with some of the most important terms. The securitization process involves pooling relatively straightforward debt obligations such as loans or bonds and using cash flows from the pool of debt obligations to pay off the bond created in the securitization process. Let's say that we have a large financial institution that issues mortgage loans. This financial institution will then have several mortgage loans as assets on its balance sheet. Say that these mortgage loans are pooled together and sold to a special purpose vehicle. So now these assets have been transferred to the special purpose vehicle. So each of these is a mortgage loan and they have been pooled together. Now, when homeowners make their mortgage payments, those payments come to the special purpose vehicle. This special purpose vehicle issues bonds called mortgage-backed securities, and the payments to these bondholders come from these particular assets. And now this definition will make more sense. So notice that this process, the securitization process, involves pooling together debt obligations. The debt obligations here are mortgage loans. The cash flow that comes in, these are payments from homeowners, are used to pay off the bonds created in the securitization process. So these are the bonds that are created in the securitization process, and cash flow coming from the homeowners, the mortgage payments, are being used to pay investors who have purchased these bonds. So we've understood, at least at a very simple level, the securitization process. Now, the distinction between asset-backed securities and mortgage-backed securities. Asset-backed securities is a larger term which deals with any security that is created by this sort of a process where the bondholder or the security holder is paid based on cash flows associated with the underlying asset. Now, the largest category of asset-backed securities is mortgage-backed securities. In other words, securities where the underlying asset is some form of a mortgage instrument. Since this is such a large market or such a large segment of asset-backed securities, often we talk about mortgage-backed securities as a separate class altogether. But at least conceptually, they are also a type of an asset-backed security. And the final term that we'll discuss on this slide is securitized assets. These particular assets, that are used as collateral for the asset-backed security, these assets are referred to as securitized assets. Let us now consider the benefits of the securitization process. One major benefit is that securitization enables investors to get direct access to liquid investments and payment streams that would be otherwise unattainable. To understand this, let's consider a scenario without securitization. We have a large bank which issues mortgage loans to homeowners. Let's say that there are several mortgage loans issued to many different homeowners, and then homeowners make mortgage payments. You are an investor and you want to participate in this market. So you would like to make these sorts of investments, mortgage-oriented investments, so that you receive a stream of mortgage payments. Obviously, it is impractical for you as an investor to go make individual investments here. So it will be extremely difficult to find the right homeowners to assess who can make payments and directly make investments with particular homeowners. Also, this would be very risky because you might make a particular investment, issue a loan, and then that particular homeowner might default. So that's not practical. You could indirectly participate in this process by having some of your money at this bank and by buying shares in the bank. But notice, your exposure to this underlying pool of assets would be indirect because there are many other factors which will impact the market price of the shares of the bank, for example. Now, with securitization, to a large extent, the role of the bank is reduced, and when the role of this intermediate entity is reduced, that's referred to as disintermediation. How does that happen? As we discussed on the previous slide, if all these mortgage loans are pooled and packaged and sold to an SPV, and the SPV issues mortgage-backed securities with the loans as collateral, now through this mortgage-backed security, you as an investor have almost direct exposure to this particular investment. So that is what's meant over here. Securitization enables investors to get direct access to liquid investments and payment streams that would be otherwise unattainable. So now, by holding on to this mortgage-backed security, you get access to the payment stream that is coming from homeowners. Let's look at another aspect now. Securitization enables banks to increase loan origination, monitoring, and collections. If you think about the overall process, given that now a large number of investors would be interested in the asset-backed securities or the mortgage-backed securities, this means that financial institutions can raise a lot more money and use that money to issue many more mortgage loans. There is a lower cost of borrowing for entities raising funds, since a lot more money is involved, and investors now are happy that with the SPV, the specific mortgage loans serve as collateral, plus the mortgage loans are also pooled together, which creates a diversification benefit. For these reasons, the cost of borrowing for the entities which are raising funds goes down. In this case, the entities raising funds are ultimately the homeowners. So the cost of borrowing for homeowners goes down, which is a good thing. Higher risk-adjusted returns for investors. Given the relatively low risk involved over here, for that level of risk, the investors in asset-backed securities or mortgage-backed securities are getting a good return, so they are happy. Greater efficiency and profitability of the banking sector. This is a larger point. Generally, at least in the United States market, the mortgage-backed securities are extremely liquid. They have a good secondary market, because of which the financial markets become more efficient. And then there will be kinds of investors who are interested in different sorts of mortgage-backed securities, which enables a good matching of assets and liabilities. And while this subject is a little beyond what we need to know right now, but the simple summary is that because of these instruments, markets become more efficient and overall the banking sector becomes more profitable. In the introduction, we spoke briefly about securitization. Here in section 3, we will discuss the process in more detail. Specifically, here are the subsections we'll cover. Now let's work through an example of a securitization transaction. We have a company called Mediquip. This sells medical equipment to customers, and since the medical equipment is expensive, the sale is financed by loans. So customers borrow money from Mediquip and use that borrowed money to buy the equipment. Since the customers are borrowing from Mediquip, Mediquip now has loan receivables on its balance sheet. So loan receivable from Mediquip will be an asset. Assume that at a given point in time, the total loan receivable is 200 million. And now Mediquip also wants to raise $200 million in cash. So one option can be to issue corporate bonds, but Mediquip realizes that when it issues corporate bonds, the cost of borrowing might be relatively high. So Mediquip sets up a special purpose entity called Medical Equipment Trust, MET. This is a bankruptcy remote entity. So now what Mediquip can do is it can sell those loan receivables, or essentially sell the loans to MET, and in return MET will make a cash payment for the loans to Mediquip. What MET, which is the special purpose entity, then does is it issues securities and sells the securities to investors. Now investors will make cash payments to MET. Since MET now owns the customer loans, the interest payments and principal payments that are made by customers will come to MET, and MET uses that money to make periodic cash payments to investors. Let us now look at the major parties and their roles in this securitization transaction. The SPV, or special purpose vehicle, is MET, Medical Equipment Trust. This is also called the trust. It is also called the issuer because this is the entity that issues the asset-backed securities. As far as investors are concerned, they are buying the asset-backed securities from the issuer. The seller of the pool of securities is also called the depositor. This is the company itself. It is Mediquip. This is the company that is selling the loan receivables to MET, or the issuer. Let's also understand the role of the servicer. Servicing involves collecting payments from borrowers, notifying borrowers who may be delinquent, and if necessary, recovering and disposing the medical equipment if the borrower does not make loan payments by a specified time. Notice that in this case, when we talk about the borrower, it is the customers who are borrowing from Mediquip. So who performs this servicer role? In our particular securitization scenario, we are saying that Mediquip performs the servicer role because Mediquip is selling to the customers. They have direct contact with the customers. So Mediquip is responsible for going after the customers and making sure that they make payments. However, it is not necessary that in all securitization transactions it is the seller. However, it is not necessary that in all securitization transactions the depositor plays the role of the servicer. It is possible that the issuer become the servicer. It is also possible that a third party is asked to play the role of the servicer, and so on. But what you need to understand is that this is an important role, and obviously that role needs to be assigned either to the issuer or the depositor or some third party. There are several other parties that are involved in the securitization process. These other parties include independent accountants, lawyers, trustees, underwriters, rating agencies, and guarantors. And hopefully it is obvious why these other parties are needed. Clearly, several legal documents need to be created, because of which we have lawyers involved. There needs to be a credit rating associated with the bonds that are issued or the asset-backed securities that are issued. That's why we need rating agencies. The trustee is typically a financial institution with trust powers that safeguards the assets after they have been placed in the trust. From an exam perspective, while it's important to recognize that these other parties are involved, but it is critical that you recognize the role of the three major parties: the SPV, also called the trust, the seller/depositor, and the servicer. Now we come to section 3.3. Up till now we have talked about simple transactions where the issuer issues one type of bond or one type of asset-backed security, but in the real world generally multiple classes of asset-backed securities are issued. The motivation for the creation of different types of structures is to redistribute prepayment risk and credit risk efficiently among different bond classes in the securitization. Prepayment risk is the uncertainty that the actual cash flows will be different from the scheduled cash flows as set forth in the loan agreements, because borrowers may alter payments to take advantage of interest rate movements. Now let's understand this. Say that MET, this is the SPV, issued the following four bond classes with a total par value of 200 million. Now it is possible that the customers, these are customers who bought medical equipment on credit. Now if those customers pay back early for whatever reason, then obviously the money that is paid back early flows through to the investor. And I'll draw the picture here very quickly. Let's say that this is the customer who buys the medical equipment, and for simplicity we will skip the seller and we will go straight to the issuer, which is the SPV. So the customer essentially is making payments that flow through the SPV, and then these payments are used to pay off the holders of the asset-backed securities. So this is the investor. If customers start paying back faster than was initially estimated, then obviously the asset-backed securities will be paid off faster and the interest income will be lower than what might have been anticipated initially. The risk of this happening is called prepayment risk. This is something that we'll discuss in more detail later, but the idea here is that the SPV could issue different bond classes where the prepayment risk is distributed. So these classes might be set up such that A1 has relatively low prepayment risk and A4 has relatively high prepayment risk. The prepayment risk cannot be eliminated, it can only be distributed across the different bond classes or tranches. What I have described here is called time tranching, and again, to emphasize why we do time tranching, this is to redistribute prepayment risk. Here are two more important concepts that we'll touch on here and discuss in more detail later: subordination and credit tranching. The question here is that if some customers default, then who faces the most risk? And what we do here is that again we might have multiple bond classes, and this structure is called subordination. If A is the senior bond class or the senior tranche and B is subordinated and C is subordinated to B, then if there are losses, the bondholders with these asset-backed securities, the most subordinated bond class, they will have to face losses first. Then bond class B will face losses, and then bond class A will face losses. So only if losses exceed 20 million will bond class A suffer. Notice that obviously the risk is highest for bond class C, and therefore if there is credit tranching, then the rate that these bondholders will get will be the highest, and the rate that these bondholders will get is the lowest. The classic principle of high risk, high return is what is being applied over here. Let us now look at the key role of the special purpose vehicle. And we go back to our Mediquip example. Let's say that Mediquip decides to issue a corporate bond backed by the various receivables. So what we are saying is, rather than deal with a special purpose vehicle and have the special purpose vehicle issue the asset-backed securities, the CFO says that I simply want to issue corporate bonds based on the receivables. In other words, the collateral for this corporate bond is these receivables. Let's also say that Mediquip has a corporate rating of BB. If this is the case, then the rating of this corporate bond is going to be heavily influenced by the overall rating of the company. Even though there is this collateral, but investors will be concerned that if payments do come in, perhaps Mediquip will use the payments for something else. There is also a concern that if Mediquip is reorganized, then what will happen to these receivables? Will the investors here still have a claim against these receivables? For these various reasons, the riskiness perceived by the bond investors would be relatively high. Since the perceived riskiness and the credit risk is high, the return that investors will demand will also be high. In other words, the credit spread is going to be high. Therefore, the cost of funding for Mediquip is going to be high. Now, let's go to the SPV scenario. With the SPV, the collateral, which is the receivables, are sold to the SPV. The SPV is a separate legal entity. Since this is a legal entity and it owns these receivables, when asset-backed securities are issued against these receivables, those investors who buy these asset-backed securities can be comfortable that any payments that come in because of these particular receivables will go to the holders of the asset-backed securities. In other words, there is this collateral that is legally protected, and because of that, the investors over here in this asset-backed scenario with the special purpose vehicle will be willing to invest with a lower return. Since investors are happier with a lower return, the funding cost also becomes lower. Remember, the return for the investor is the cost for the issuing entity. So that is the main point. Also notice through this discussion that the SPV is a bankruptcy remote vehicle. What that means is, if there is a bankruptcy over here with Mediquip, or if there is a reorganization, that does not impact the special purpose vehicle. As I've said multiple times, that is because the special purpose vehicle is a separate legal entity. As long as the customers who've taken out loans keep making payments, those payments will flow through to the investors in this situation, regardless of what is happening to Mediquip.